Special features of audit of banks and NBFC. Unit 1. Special features of audit of banks. Legal framework. Principal enactment which governs functioning of several types of banks are Banking Regulation Act 1949, Reserve Bank of India Act 1934, State Bank of India Act 1955, Regional Banks Act 1976, Companies Act 2013. Main heading: Appointment of Auditor. Subheading: Appointment letter for statutory central audit. Most bank appoint 4 or more CA firms to act jointly as statutory central auditors. Appointment letter contains following: period of appointment, particulars of other central auditors, particular of previous auditors, procedural requirements to be complied, statement of division of work and responsibilities among joint auditors, scope of assignments. However, statutory branch audit is carried out by single CA firm. In case of statutory branch auditors, appointment letter is similar except particulars of other auditors and statement of division of work. Subheading: Appointment Authority. Auditor of banking company is to be appointed at AGM of shareholders, whereas auditor of nationalized bank is to be appointed by bank acting through its board of directors. In either case, approval of RBI is required before appointing is made. Special consideration in audit of banks for conducting an auditor. Main heading. Subheading: Peculiarities which may necessitate special audit consideration in audit of banks. Special audit consideration arise in audit of banks because of particular nature of risk associated with transactions, scale of banking operations, and significant exposures can arise within short time. Extensive dependence on IT to process transaction, effect of statutory and regulatory requirements, contingent continuing development of new services and banking practices, process of conducting audit of banks, initial considerations, acceptance and continuance, declaration of indebtedness, terms of audit engagement, communication with previous auditors, planning, establish engagement team, understanding bank and its environment including internal control, understand bank's accounting process, understanding risk management process, become उसमें से सब पॉइंट्स है oversight by TCWG, identification, measurement and monitoring of risk, control activities, monitoring activities, reliable information systems, risk assessment, identifying and risk and assessing risk of material misstatement, assess risk of fraud including money laundering, assess specific risk, execution, engagement team discussions, prepare response to assessed risk, establish overall audit strategy, determine audit materiality, consider going concern. Reporting. Independent auditors report, long form of auditor report any other matters to bank, regulators or government, special consideration in IT environment, sharing of information with auditors, considering importance of IT systems in preparation and presentation of financial statement. It is imperative that banks should share detailed information with auditors like overall IT privacy policy and structure of bank's IT system, data processing and data interference under various systems, data integrity and data security, controls on recording of various e-banking and internet banking products, MIS reports and major exceptions reports, and their process of generation, various information related to disclosure in financial statements, key security aspects that auditor needs to address, key security controls aspects that auditor needs to address when undertaking audit in computerized bank include: ensure that authorized, accurate, complete data is available for processing. Ensure that in case of power failure, system restarts without storing records. Ensure that system prevents available. Ensure that system prevents unauthorized amendments to programs, verify that segregation of duties is ensured while granting system access, verify that changes made in parameters to or user levels are authenticated, verify that exceptional reports are authorized and verified on daily basis. Internal control in certain selected areas. Focus area cache, example of internal controls in bank. Cash could be kept in joint custody of two responsible officers. In addition to normal checking by chief cashier, cash should be test checked daily. Cashier should have no access to customer ledger accounts and daybook. Payment should be made only after vouchers passed by the authorized officer. High value cash receipts and payments should be verified by higher officer. Loans and advances. Bank should make advances only after satisfying about creditworthiness of borrowers and after obtaining sanction from proper authorities. All all necessary documents should be executed by parties before advances are made. Sufficient margin should be kept against securities taken to cover decline in value. All securities should be kept in joint custody of two responsible officers. All securities should be registered in name of bank. All accounts should kept within drawing power and sanction limit. Additional temporary limit may be sanctioned for maximum 20% of existing limit and 90 days tenure. All accounts which exceed sanctioned limit or drawing power should be brought to notice of management regularly. Operation in each advance account should be reviewed at least once every year. Credit card operations. There should be a system for effective screening of application, strict of control over storage and issue of cards, prompt reporting by merchandise of all settlements accepted through credit cards, ensuring statements are sent regularly and promptly to customers, monitor and follow up customers' payments, identification of payments and overdue beyond a reasonable period, periodic review of credit card holders' account. Main point: compliance with CRR and SLR requirements, meaning CRR is specified minimum fraction of total customers' deposits which banks have to hold as reserve either in cash or deposits with RBI. SLR is the requirement that bank is required to maintain in the form of liquid assets such as gold and cash before providing credits to customers. Special points in audit of compliance with CRR and SLR requirements. Verify compliance with the SLR requirements of 12 odd dates, not being Fridays. Obtain understanding of relevant circulars or instructions of RBI. Examine consolidations regarding detail positions for prepared by bank with related returns received from branches. Examine whether consolidation prepared by bank includes information of all branches. In detail computation, examine following items are excluded from liabilities: paid up capital, reserves and loan taken from RBI, part amount of recoveries from borrowers in respect of bad debts, amounts received against import bills in Indian currency, unadjusted balances for agency business, margins held in sundry deposits for funded facilities. Similarly, examine following items is included in liabilities: net credit balance in branch adjustment accounts, borrowing from abroad, Main points: verification of advances, substantive audit procedures, verify correctness of master data of loan accounts updated in central banking system, check parameters like installments, EMI, rate of interest, tenure of loans, etc. Examine all large advances while other advances may examined on sample basis. Examine identified problems accounts which are not yet slipped into NPA category. Examine accounts which are adversely commented by concurrent auditors or bank internal inspections, RBI inspection team. Examine restructured accounts list to ensure restructure is as per RBI guidelines. Verify completeness and accuracy of interest charge. Carry out appropriate analytical procedures. Recoverability of advances. Review periodic statements submitted by borrowers indicating compliance with terms and conditions. Review latest financial statements of borrowers. Review reports on inspection of security. Review auditors' report of borrowers having credit facility beyond cutoff limits. Main points: verification of asset classification, income recognition, and provision for NPA. Classification and provision: verify whether banks has system of classification of advances through CBS without manual intervention. Examine whether classification made by branch is appropriate. Examine whether secured and unsecured portions of advances have been segregated correctly and provisions have been calculated properly. Review and compare date of NPA of loan accounts mentioned in current year statements with previous years. Reasons for any change should be ascertained. Accounts regularized near balance sheet date. Okay. As per RBI guidelines, if accounts has been regularized before balance sheet date by payment through genuine sources, account need not be treated as NPA. If subsequently branch has provided further funds to borrower, auditors should carefully assess whether repayment was out of genuine sources or not. If accounts indicates inherent weakness, account should be deemed as NPA. Drawing power calculation. Okay. Ensure that drawing power is calculated as per guidelines formulated by Board of Directors. Special consideration should be given to proper reporting of sundry creditors and stock covered under LC's guarantees for calculating drawing power. Drawing power needs to be calculated carefully in case of working capital advances to companies engaged in construction business. Stock auditors' report should be reviewed and special focus should be given to comments made by stock auditors on calculation of drawing power. Accounts with temporary deficiencies. Okay. Bank should not classify an advance account as NPA merely due to existence of some temporary deficiencies such as non-availability of drawing power based on latest available stock statement, balance outstanding exceeding the limit temporarily, and non-renewal of limits on due date. However, stock statements for determining drawing power should not be older than 3 months. Ensure adherence to these guidelines. Limits not revealed. Okay. Accounts where regular or ad hoc limits are not reviewed within 180 days from due date or date of ad hoc sanction should be considered as NPA. Ensure that ad hoc or short reviews are not done and on repetitive basis. Asset classification borrow wise. Okay. Ensure that asset classification is borrower-wise and not facility-wise. It is to ensure that all facilities granted by bank to borrower will be treated as NPA and not particular facilities which has become irregular. Government guaranteed advances. Okay. If government guaranteed advances become NPA, then income on which advance is recognized only when interest is realized. Central government guaranteed advances is treated as NPA only when central government repudiates its guarantee when invoked. State government guaranteed advances is treated as NPA if it remains overdue for more than 90 days. In case bank has not invoked central government guarantee through amount is overdue for long, it should be duly reported in LFAR agricultural advances. Ensure that NPA norms have been applied as per crop season, short term or long term, on all direct agriculture advances listed in circular. For agriculture loans not specified in particular, ensure that identification of NPA has been done on some basis as non-agricultural advances. Restructured advances. Restructuring is an act in which lender grants concession to borrower for reasons relating to borrower's financial difficulty. It may involve modification of terms of advances, including alteration of installment amount or repayment period, rate of interest or sanction, etc. Banks may restructure the accounts classified under any categories. Banks cannot restructure accounts with retrospective effect. On restructuring, account will be downgraded from standard to substandard. NPAs will remain in same category. Sale or purchase of NPAs. In case of sale or purchase of NPA by bank, auditors should examine policy laid down by board of directors relating to procedures, valuation and delegation of powers for sale or purchase. Only such NPA has been sold which remained NPA in books for at least 2 years. NPA have been sold or purchased without recourse only, that is, entire credit risk associated with NPA transferred to purchasing bank. Subsequent to sale of NPA, bank has not assumed any risk relating to all in so, relating to sold NPAs. Okay, मतलब बेचा हुआ. NPA has been sold at its cash basis only. Bank has not purchased an NPA which it had originally sold. Special points in case of sale of NPA. NPA has been removed from bank books of selling bank. If sale below NPV, shortfall should be debited to P&L. If sale more than NBV, net book value, excess will utilize to meet loss on other NPA. Special points in case of purchase of NPA. Provision should be made for NPA purchased as per classification status in books of purchasing bank. Any recovery from NPA purchased is first adjusted against its acquisition cost and excess has been recognized as profit. For capital adequacy, banks assigned 100% risk weights to NPAs purchased from other banks. Verification of capital and liabilities. Capital. Capital is divided into two tiers. Tier 1 capital consists mainly of share capital and disclosed reserves, and it is a bank's highest quality capital because it is fully available to cover losses. Tier 2 capital consists of certain reserves and certain types of subordinated debt. Loss absorption capacity of Tier 2 capital is lower than Tier 1 capital. Capital risk adequacy ratio. Eligible total capital funds divided by risk-weighted assets and off-balance sheet items into 100. RBI requires banks to maintain minimum CRR is 9%. Borrowings. Obtain and verify confirmation certificates and other documents. Comply with requirements of ASIL 505 external confirmation. Examine whether clear distinction is made between discount and refinance. Examine whether borrowing of money at short notice are properly authorized. Bills payable. Evaluate existence and effectiveness of internal controls over bills payable. Such controls should usually include following: draft, mail, transfers, etc. should be made out in standard printed form. Unused forms should be kept under custody of responsible officer. Banks should have reliable private code known only to responsible officers. Signatures on demand draft should be checked by officer with specimen signature book. Examines ample of outstanding items in bills payable with relevant registers. Main point: verification of contingent liabilities. Disclosure requirements. Disclosure requirement of contingent liabilities for banks. Claims against the bank not acknowledged as debt. Liabilities for partly paid investments. Liability of outstanding forward exchange contracts. Guarantees given on behalf of constituents in India or outside India. Acceptance, endorsement, and other obligations. Other items for which bank is contingently liable. Management representation. Auditor shall obtain representation from management that all off-balance sheet items transactions are accounted in books such transactions has taken place. All balance sheet transactions are entered after following due procedures. All of balance sheet transactions are supported by underlying documents. All year-end contingent liabilities have been disclosed. Disclosed contingent liabilities do not include any crystallized liabilities which require creation of provision in financial statements. Audit procedures. Test completeness of recorded obligations, review reasonableness of year-end amounts of contingent liabilities, review minutes of board of meeting, contracts, agreements, and list of pending legal cases to identify claims against bank, ascertaining status of claims outstanding at end of year from management, verify outstanding verify outstanding forward exchange contracts with statements generated from bank accounting system, ascertain whether there are adequate internal controls over issuance of guarantees and unused guarantee forms, evaluate adequacy of internal controls over issuance of letter of credit, verify balance of letter of credit from registered maintained by bank. Main point: auditors report. Reporting to central government. In case of nationalized bank, auditor is required to make a report to central government in which auditor should state following: whether balance sheet contains all necessary particulars and is properly drawn up so as to exhibit a true and fair view of affairs of bank. In case of auditor has called for any explanation or information whether it has been given, whether transaction which have come to auditor's notice within powers of bank, whether returns received from branches of bank have been found adequate of audit, whether profit and loss account shows true balance of profit or loss for period of covered, any other matter which auditors consider to be brought to notice of central government. Reporting of matters covered under Companies Act 2013. Okay, auditors of a bank company is also required to state in report the matters covered by Section 143 of the Companies Act 2013. Auditors' report shall also include their views and comments on following matters, namely, whether compliance has disclosed impact of pending litigations in financial statements, whether company has made provisions for material foreseeable losses on contracts, whether there has been any delay in transferring amounts to investor education and protection fund by company, whether dividend declared or paid by company is in compliance with Companies Act 2013, whether company has used such accounting software for maintaining its books which has feature of recording audit trail facility and same has been operated throughout the year. Reporting requirements relating to companies order Simple Caro 2020 are not applicable to a banking company. ये तो दिया है exception में. Long form of audit report इसको ही बोलते हैं LFAR. LFAR is to keep in statutory audit, statutory branch auditors as well as statutory central auditors. LFAR for branch auditors is in form of questionnaire where observations or comments have to be provided on range of matters including cash balance with banks, investments, advances, etc. These are submitted by statutory branch auditors to statutory central auditors. Consolidation is done at head office level. LFAR for bank is submitted by statutory central auditors to management. Copy of LFAR together with board views or directions is submitted to RBI within 60 days of submission of LFAR by statutory auditors. Other reports and certificates. Statutory Central Auditor also provides reports and certificate on following: reports on operating effectiveness of internal financial controls over financial reporting, reports on compliance with SLR requirements, reports on whether treasury operations conducted as per RBI instructions, report on instances of adverse credit deposit ratio in rural areas, certificate on reconciliation of securities by bank, certificate on corporate governance. Woo! Concurrent audit, meaning concurrent audit is an audit or verification of transactions or activities of an organization concurrently as the transaction or activity takes place. It is not a pre-audit. Concept in this audit is to verify authenticity of transaction or activity within shortest possible time. It is similar to internal audit. Scope and coverage. Detailed scope of concurrent audit and coverage of branches should be determined by inspection and audit department of bank with approval of audit committee of board of directors. Guidelines issued by RBI cover all key areas of activities of branch which is under concurrent audit. Following areas are covered by these guidelines: cash deposits, advances, investments, foreign exchange, housekeeping, and other items. Focus areas: advances, audit procedure or focus areas in case of advances. Ensure that loans and advances have been sanctioned properly. Ensure that securities have been received and properly registered. Ensure that post-disbursement supervision and follow-up is proper. Check whether letter of credit issued are within delegated power. Check whether bank guarantees issued are properly recorded in register. Ensure proper follow-up of overdue bills of exchange. Verify whether classification of advances is done as per guidelines. Foreign exchange. Okay. Audit procedure or focus areas in case of foreign exchange transaction. Check foreign bills negotiated under letter of credit. Check whether inward or outward remittance have been properly funded. Examine extension and cancellation of forward contracts for purchase and sale of foreign currency. Ensure that balances in nostro accounts in foreign currencies are within limit. Ensure adherence to guidelines issued by RBI about dealing room operations. Ensure reconciliation of nostro and vostro account balances. Appointment of concurrent audits. Concurrent audits can be done by bank's own staff or external auditors. If bank has engaged its own officials, they should be experienced, well-trained and senior. They must be independent of branch where concurrent audit is to be conducted. ACB मतलब appointment of concurrent ACB of bank shall decide maximum tenure of external concurrent auditors. Generally, it shall not be more than 5 years. However, no concurrent auditor shall continue with a branch for more than 3 years. If any serious irregularities are noticed in working of external concurrent auditors, their appointment may be cancelled and fact may be reported to RBI and ICA. Reporting system in concurrent audit. There should be proper reporting of findings of concurrent auditors in structured format. There should be zone-wise reporting of findings of concurrent audit to ACB. Before submission of report, auditor should discuss important issues with branch manager. Minor irregularities are to be rectified in a timely manner. Serious irregularities should be reported to head office for immediate action. If fraudulent transactions are detected, they should immediately be reported to inspection and audit department of banks, chief vigilance officer and concerned branch managers. Follow-up action on concurrent audit report should give high priority. Okay, Unit 2 started. Chapter 9, Unit 2, Special Features of Audit of Non-Banking Financial Companies. Definition, registration and regulation of NBFC. Definition. RBI Act 1997 defines NBFC as a financial institution which is a company. A non-banking institution which is a company with principal business of receiving of deposits or lending in any manner. Such other banking institutions such as RBI may specify by notification in official gazette with previous approval of central government. Registration and regulation. Company will be treated as NBFC when company is 1. Financial assets constitute more than 50% of total assets, excluding intangible assets. 2. Income from financial assets constitutes more than 50% of gross income. And another company which fulfills both these criteria shall qualify as NBFC and would require to be registered as NBFC by RBI. No NBFC shall commence or carry business of NBFC without obtaining certificate of registration issued by RBI and having net owned fund of rupees 10 crore, rupee 2 crore for some NBFC. Company incorporated under Companies Act and desirous of company's business of NBFC can apply to RBI in prescribed form for registration. Difference between banks and NBFC. NBFCs lend and make investments and hence their activities are similar to banks. However, there are few differences between the two as given below. NBFC cannot accept demand deposits. However, some NBFC can accept term deposits. NBFCs do not form part of payment and settlement system and cannot issue checks drawn on itself. Deposit insurance facility is not available to depositors of NBFC unlike in banks. No minimum exposure to priority sector required by NBFC. Types and classification of NBFC. Types. NBFC registered with RBI are categorized as follows. Deposit and non-deposit taking NBFC. Non-deposit taking NBFCs by their size into systematically important and non-systematically important. NBFC and NSDI and NBFC ND. By kind of activities they conduct, types of NBFCs in this category are ICC, Investment and Credit Company, IFC, Infrastructure Finance Company, CIC NDSI, Systematically Important Core Investment Company, Infrastructure Debt Fund, Non-Banking Financial Company, Microfinance Institution, Non-Operative Financial Holding Company, Assets Finance Company, Investment Company, Loan Company, etc. Classification. NBFC are classified into 4 layers. These 4 layers are NBFC base layer, middle layer, upper layer, top layer. NBFC base layer. It comprises of non-deposit taking NBFC below asset size of rupees 1000 crore. NBFC middle layer. It consists of all deposit taking NBFC irrespective of asset size, non-deposit taking NBFC with asset size of rupees 1000 crore and above, NBFC undertaking following activities: infrastructure finance companies, core investment companies, infrastructure debt fund, and housing finance companies. NBFC upper layer. It comprises of these NBFCs are specifically identified by RBI. NBFC top layer. It will be ideally remain empty and will be filled by RBI based on required need. Classification of frauds by NBFC. Misappropriation and criminal breach of trust, fraudulent encashment through forged instrument or manipulation of books of account, unauthorized credit facilities extended for reward, negligence and cash shortages, cheating and forgery, irregularities in foreign exchange transactions, any other type of fraud not coming under above heads, cases of negligence and cash shortages and irregularities in foreign exchange transactions are to be reported as fraud of intention to cheat is proved except following. Cash shortages more than rupee 10,000, Cash shortages more than Rupee 5,000 if detected by management or auditor and not reported on occurrence by persons handling cash. Prudential norms. Capital requirements. Every NBFC shall maintain minimum capital ratio consisting of Tier 1 and Tier 2 capital which shall not be less than 15% of aggregate risk-weighted assets. Tier 1 capital shall not be less than 10% at any point of time. Value of each assets requires to be multiplied by relevant risk weights to arrive at risk-adjusted value of assets. Percentage of risk weights assigned to assets are cash and bank balance is investments in approved securities, fully secured loans and advances, loans to staff, TDS advance tax, interest on government securities, central government guaranteed claims, investments in bonds of public sector banks, state government guaranteed claims, not in default or in default up to 90 days, 20% आएगा. Infrastructure projects in existence over a year of commercial operation 50%, others 100%. मतलब इसको risk weight दिया जाएगा 0, 20, 50, 100. Provisions requirements. Every NBFC shall make provisions against loss of doubtful debts, doubtful assets, substandard assets and standard assets. लॉस एसेट्स का तो 100 आएगा. डाउटफुल अगर डाउटफुल एसेट्स है और अनसिक्योर्ड है तो उसका सीधा सीधा 200 आएगा. उसने सिक्योर किया. डाउटफुल अगर 1 साल तक है तो 20% आएगा, 20 आएगा, 20% आएगा. और 1 साल से 3 साल तक है 30% आएगा. और 3 साल से ज्यादा डाउटफुल है और सिक्योर्ड है तो 50% आएगा. ठीक है. Substandard assets 10%. Standard asset non-systematically important non-deposit taking 0.25, other 0.4. Audit procedures. Areas which are mandatorily part of audit procedures for conducting audit of NBFC. Ascertaining business of company. First step is in audit of NBFC is scan through memorandum and articles of association so as to acquaint oneself with the type of business that the company is engaged into. Evaluation of internal control system. Auditor should understand accounting system and related internal controls adopted by NBFC to determine NT of his audit procedures. Auditor should also ascertain whether internal controls put in place by NBFC are adequate. Registration with RBI. Auditor also verify whether dual conditions relating to registration with RBI and maintenance of minimum net owned funds have been duly complied with by NBFC. NBFC acceptance of public deposits directions. Ascertain whether company has complied with following aspects in relation to activity of mobilization of public deposits. Ceiling on quantum of NBFC quantum of public deposits is linked to credit rating. Obtain copy of credit rating assigned to NBFC and check whether public deposits accepted are as per credit rating assigned to it. In event of upgrading or downgrading of credit rating, ensure that NBFC has informed the same to RBI. In event of downgrading of credit rating, NBFC shall stop ascertaining fresh and renewing existing deposits. All existing deposits shall run off to maturity and report position within 15 days to RBI. Test check interest calculation of public deposits mobilized by NBFC. Verify deposit register maintained and test check particulars with supporting receipts. Check whether investments made in liquid assets lodged in safe custody with scheduled bank. Check whether NBFC has filed returns in timely manner. In case of NBFCs not accepting deposit, check whether board resolution is passed. NBFC prudential norms. To ensure compliance of prudential norms by NBFC, auditor shall check compliance of norms relating to income recognition, income from investments, asset classification, provision for bad debts, capital adequacy norms, for concentration of credit, etc. Ensure that Board of Directors of NBFC shall frame a policy for granting demand loans, verify loan and advances have been properly classified as standard, substandard, doubtful loss, and proper provision has been made. Ensure that unrealized income from NPA has not been taken to P&L. Check whether all accounts which have been classified as NPAs in previous year also continue to be shown as much in current year also. Audit checklist in case of NBFC, investment and credit company. Verification procedure points to be covered in audit of investment and credit company. Physically verify all shares and securities held by NBFC. Verify whether NBFC has not advanced any loans against security of its own shares. Verify that dividend income is duly received by NBFC and interest is duly accounted. Verify board minutes for purchase and sale of investments. Check whether investments have been valued as per NBFC prudential norms directions. Obtain list of groups companies from management and verify investments made in group companies. Examine whether each loan or advance has been properly sanctioned. Obtain balance confirmation from concerned properties. Check whether NBFC has not invested in excess specified limits. Check classification of loans and advances made by NBFC into standard, substandard, doubtful, and loss assets. Auditor's duty to report. Matters to be included in auditor's report to Board of Directors of NBFC. In case of all NBFC, auditor shall include statements on following matters: whether company has obtained certificate of registration from RBI. In case of company holding certificate of registration, whether company is entitled to continue hold such certificate of registration. Whether NBFC is meeting net own fund requirements. In case of NBFC accepting or holding public deposits, auditor shall include statements on following matters: whether public deposits accepted by company are within admissible limits, whether public deposits held by company in excess of quantum of such deposits permissible to it, whether capital adequacy ratio disclosed in return is correctly determined, and whether it is compliance with minimum CRR prescribed, whether company has violated any restriction on acceptance of deposit, whether company has complied with prudential norms, whether company has complied with liquid assets requirement, whether company has furnished return on deposits and quarterly return on prudential norms to RBI within stipulated period. In case of NBFC not accepting public deposits, auditor shall include statements on following matters: whether Board of Directors has passed resolution for acceptance of public deposits, whether company has accepted any public deposits during the relevant period, whether capital adequacy ratio disclosed in Form NBS 7 has been correctly arrived, and whether it is in compliance with minimum CRR prescribed, whether company has complied with prudential norms. Obligation of auditor to submit exception report to RBI. Auditor has obligation to submit exception report to RBI on following matters: where in case of NBFC statement regarding any items of unfavorable or qualified or in opinion of auditor, company has not complied with provisions of Chapter 3B of RBI Act or NBFC Acceptance of Public Deposits Directions 2016 or NBFC Non-Systematically Important Non-Deposit Taking Company Directions 2016 and NBFC Systematically Important Non-Deposit Taking Company and Deposit Taking Company Directions 2016, it shall be obligation of auditor to make report containing details of such unfavorable or qualified statements and about non-compliance of company to concerned regional office of non-banking supervision of RBI. Duty of auditor shall be reported only contraventions of provisions referred above, and such report shall not contain any statement regarding compliance of any of those provisions. Difference between Division 2 and Division 3 of Schedule 3. Division 2 क्या होता है? इंडियस अदर देन एनबीएफसी के लिए होता है, और डिवीजन 3 किसके लिए होता है? इंडियस एनबीएफसी के लिए होता है. Presentation requirements under Division 3 of NBFC are similar to Division 2 a large extent except following. NBFC is allowed to present items of balance sheet in order to liquidity, which is not allowed under Division 2. NBFC is required to separately disclose by way of note in any item of other income or other expenditure which exceeds 1% of total income. Division 2 requires disclosure for any item of income or expenditure which exceeds 1% of revenue or rupee 10 lakh, which is higher. NBFCs are required to separately disclose under receivables debts due to LLP in which its director is a partner or member. NBFCs are also required to disclose items comprising of revenue from operations and other comprehensive income to face P&L instead of part of notes. Separate disclosures of trade receivable which have significant increase in credit risk. Conditions or restrictions for distribution of statutory reserves have to be separately disclosed. कंप्लायंस विद कारो चैप्टर 3 में डिस्कस कर चुके हैं. चैप्टर 9 इंडेड